I think we've built a narrative here, haven't we, this morning in the United States of America? GDP was better than estimated. They're going to have to perhaps review that in the UK. But everybody's now coalescing around the view that maybe it just isn't so bad in Europe with that print of GDP of 0.4%. Take that forward for me in terms of policy implication.
Yeah, I mean, you're right. We do see the Eurozone in that same context where growth, well, it's already now been confirmed in Q1, was better than consensus. And actually, that consensus had come up a bit over the weeks previous, so significantly better than was expected, a couple of months ago. It's a reminder the Eurozone is far from out of the woods, but things are perhaps not as bad as people were thinking at the beginning of the year. From here, we think growth settles at around 0.3 quarter on quarter over the balance of this year. With inflation where it is, unemployment where it is, there's certainly no rush for the ECB, to put it mildly, to do anything on policy. But we think by the beginning of next year, they will feel confident enough to start the very slow process of rate normalization. So for us, albeit not for the best part of a year, the next move in rates in the Eurozone will be an increase in policy rates, moving them slightly less negative, and by the middle of next year, rates will be back at zero and then moving up very slowly thereafter. So, Q1 ultimately was a bit more reassuring than people were thinking, and we expect to see some stabilization in the PMIs that reflects that as well.
The consequence, of course, is for the core European bond markets. Do they begin to reprice as we go into the second half of the year based on that? That's a slightly earlier call for normalization, perhaps than some other institutions, which are talking about the back end of 2020. So in terms of the bond markets that you look at, what's the consequence there?
Yeah, I mean, normalization's maybe stretching it a bit, but certainly we think yields move a bit higher in those core markets, really, for a variety of reasons. Firstly, the safe haven bid, which is part of the reason that, for example, 10-year bond yields got down into negative territory briefly, should fade as worries about the economy are alleviated. Secondly, that front-end anchor in terms of short-end official policy rate expectations holding the yield curve down should also start to ease. And there'll be a sort of pickup in sentiment. So, yeah, we do think that those sovereign yields do start to edge higher.